Look at this graph. This is what everyone tells you to buy. VTSAX, VOO, the S&P 500. And they're right. If you want to work for 25 years, but here's what nobody's telling you. The S&P 500 isn't just your safety net. It's your prison. It's the thing keeping you trapped in that cubicle until you're 50, 55, maybe 60 years old. I'm about to show you the 3 portfolio strategies that professional fund managers use to generate 15% plus returns. Strategies that could cut your timeline to financial independence in half. And step number 3, that's the nuclear option, the one that separates the people who retire at 65 from the ones who walk away at 37. But I have to warn you, this isn't for everyone. What I'm about to share requires discipline, research, and the willingness to handle volatility that would make most investors lose sleep. So if you're still watching, let's go. Welcome back to the channel. If you're new here, I'm Brian, and we're building the Wealth Acceleration Blueprint, the step-by-step system to achieve financial independence in 10 years, not 30. Now, before we dive in, I need to say something important. This video is part of a series. If you haven't watched video 1, the 10-year FIRE loophole, where we eliminated high-interest debt and freed up your cash flow, stop right now and go watch that first. Because if you're carrying credit card debt at 22% interest while trying to beat the market, you've already lost. The strategies I'm sharing today only work if your financial foundation is solid. Emergency fund in place, debt under control, cash flow optimized. All right, assuming you've done the work, let's talk about why the advice you've been following is killing your timeline. The problem with average. Here's the standard advice you hear everywhere. Just buy an S&P 500 index fund. Historically, it returns 10% per year. Set it and forget it. You'll be rich when you're 65. And you know what? That advice is not wrong. For most people, that's exactly what they should do. Index funds are brilliant. They're low cost, they're diversified, they eliminate stock picking risk, and over 30 years, they absolutely work. But we're not building a 30-year plan. We're building a 10-year escape plan, and that changes everything. Let me show you why this matters. Let's say you're investing $2,000 a month, which, if you've been following this series, you've freed up through the debt elimination strategy. At 8% returns in an S&P 500 index fund, after 10 years, you'd have roughly $366,000. After 15 years, about $680,000. After 25 years, you'd hit $1.9 million. Now, let's run the same calculation at 15% returns. After 10 years, $552,000. After 15 years, $1.2 million. After 25 years, $5.2 million. That difference between 8% and 15%, that's the difference between retiring at 52 and retiring at 37. That's the difference between grinding through midlife with no options and having total freedom in your prime. But here's the problem with index funds that nobody talks about. When you buy the S&P 500, you're buying the best 500 companies in America. And you're also buying the worst. Studies show that only about 25% of stocks in the index actually drive most of the returns. The other 75%? They're either flat, declining, or actively dragging down your performance. You're buying Apple, Microsoft, and Nvidia, companies generating massive returns. But you're also buying struggling retailers, legacy industrials, and companies whose best days are behind them. That's the average you're accepting. And average doesn't get you to FIRE in 10 years. So the question becomes, what if you could eliminate the dead weight and concentrate on just the winners? That's exactly what we're about to build. The 3 pillars. All right, here's the framework. I call this the accelerated portfolio, and it's built on 3 pillars. 1, the sector bet, 30 to 40% of new capital. 2, the wide moat concentration, 50 to 60% of your portfolio. 3, the small cap speculation, 5 to 10%, the nuclear option. Let's break down each one. Pillar 1, the sector bet. The first pillar is about aggressive rotation into high-growth sectors. Here's the concept. Instead of buying the entire market, you identify 1 or 2 sectors that are positioned to dominate the next 3 to 5 years. Not last year, not 10 years from now, the next 3 to 5. Right now, that might be AI infrastructure and semiconductors, renewable energy and battery technology, cybersecurity, biotech focused on longevity. Notice I'm not giving you specific stock picks. This isn't investment advice, this is a framework. You need to do the research or work with a financial advisor. But here's the key. You're looking for structural, unstoppable trends, not fads, not hype. For example, whether you believe in electric vehicles or not, the infrastructure supporting electrification, the battery manufacturers, the lithium miners, the grid modernization companies, those are sector bets with real runway. The action. Allocate 30 to 40% of your new monthly capital into these high-growth sectors. This is not your entire portfolio. This is your acceleration engine. And here's the rule. You reassess this every year. Sectors change. Winners rotate. You have to stay active. But here's where most people mess this up. They go all in on speculation. That's how you blow up your account. Which brings us to Pillar 2. Your anchor. Pillar 2. The wide moat concentration. This is the core of your portfolio. 50 to 60% of your total holdings. And this is where you replace the index fund. But without the baggage, the concept. Warren Buffett popularized the term economic moat. It's the competitive advantage that makes a company nearly impossible to compete with. Think of it like a medieval castle. The moat protects it from attackers. A wide moat means nobody can touch you. In business, that means near monopoly market positions, network effects. The more users they have, the more valuable they become. High switching costs. Customers can't easily leave. Brand dominance. Companies like Microsoft, operating system dominance, cloud infrastructure. Google, search monopoly, ad ecosystem. Visa and MasterCard, payment processing duopoly. Costco, membership model, scale advantages. These are companies that consistently beat the index, year after year, not because they're flashy, but because they're untouchable. The action. Instead of buying 500 companies, you concentrate your core portfolio into 5 to 10 of these wide moat leaders. You're essentially building your own elite index fund, but you've eliminated the losers. Now, you might be thinking, isn't concentration risky? Yes, but here's the trade-off. Diversification protects you from disaster, but it also dilutes your returns. If you're trying to hit fire in 10 years, you can't afford to dilute. You need concentrated exposure to proven winners. Of course, you should never put all your eggs in one basket. That's why this is 5 to 10 companies across different sectors, not 1 or 2 stocks. Pillar 3, the small cap speculation. All right, this is the nuclear option, the accelerator, the thing that turns a good portfolio into a wealth-building machine. But it's also the riskiest. The concept. You allocate a small, strictly defined portion, 5 to 10% of your portfolio, into highly speculative small-cap growth companies. These are companies that might not even be profitable yet, pre-revenue, pre-profit. But if they execute, they could 10x, 20x, maybe even 50x your investment. Think, early-stage biotech companies with breakthrough drugs in FDA trials, small software companies building AI tools before the market realizes their potential, emerging EV charging networks, tiny semiconductor designers with proprietary tech. Here's the critical rule. You only invest money you can afford to lose completely. I'm not exaggerating. Small cap speculation is where you could lose 100% of your investment. These companies can go to zero. But if even one of them hits, that single winner could generate returns that compress your entire FIRE timeline by years. This is why this is only 5 to 10% of your portfolio. It's not a gamble if you've sized it correctly. It's a calculated, asymmetric bet. You're risking a small amount for the chance at life-changing returns. The action. Set a hard limit. Let's say your portfolio is $100,000. You put no more than $5,000 to $10,000 into small cap speculation. Then, you research obsessively. You read earnings reports. You understand the industry. You don't chase hype, and you accept that most of these bets won't work out. But the one that does, that's your accelerator. Risk management and the math, the comparison. All right, let's put this all together and run the numbers. Standard index portfolio. 100% S&P 500. Average return, 8% annually. $2,000 per month contribution. After 10 years, $366,000. Accelerated portfolio, 30 to 40% sector bet, targeting 18 to 20% returns. 50 to 60% wide moat concentration, targeting 12 to 15% returns. 5 to 10% small cap speculation. Wild card, negative 100% to plus 500%. Blended target return, 15% annually. $2,000 per month contribution. After 10 years, $552,000. That's an extra $186,000 in 10 years. And if one of your small cap bets hits big, you could be looking at $600K, $700K, or more. That's the difference between, maybe I can coast fire, and I'm financially independent right now. But here's what you absolutely need to understand. Warning number 1, volatility. This portfolio is going to swing hard. Where the S&P 500 might drop 10 to 15% in a bad year, your accelerated portfolio could drop 20, 25, even 30%. You will see red. You will question yourself. You will wake up and see your portfolio down $50,000 in a month. If that's going to make you panic sell, this strategy is not for you. Warning number 2, active management required. This is not set it and forget it. You need to rebalance annually. You need to review your sector bets. You need to monitor your wide moat companies to ensure they're still dominant. If you don't have the time or willingness to do this, stick with index funds. Warning number 3, emergency fund is non-negotiable. You must have 6 to 12 months of expenses in cash before you even think about this strategy. Because if you lose your job in a downturn and your portfolio is down 25%, you cannot afford to sell at the bottom. Look, I'm not saying this to scare you. I'm saying this because the people who succeed with accelerated strategies are the ones who go in with eyes wide open. Here's the bottom line. If you want to achieve financial independence in 10 years, you cannot afford to be average. Average returns get you average results, and average results mean you're working until you're 60. The accelerated portfolio isn't about recklessness. It's about calculated concentration. It's about cutting out the dead weight and focusing on the companies and sectors that are actually driving wealth creation. 30 to 40% in high-growth sectors, 50 to 60% in wide moat market leaders, 5 to 10% in small-cap speculation. That's your framework. So here's your homework. Pull up your current portfolio. Look at your holdings. Ask yourself, what percentage is concentrated in high-quality, wide moat companies? Are you diversified into mediocrity or concentrated into excellence? Do you have any exposure to the sectors that will define the next 5 years? That audit is your starting point. Now remember, this accelerated portfolio only works if you've eliminated high-interest debt first. If you missed video 1, the 10-year fire loophole, click the card in the corner right now and watch it before you do anything else. And if you want to see how to transition from this aggressive accumulation phase into coast fire in just 7 years, that's exactly what we're covering next Monday. So subscribe, hit the notification bell, and drop a comment below. What are your top 3 wide moat stocks right now? I want to see what you're thinking. I'll see you in the next one. Let's build wealth faster.